coffee in me as possible. Too loud. Wow, I've never gotten that one before. Hold on, I can turn it down. Better? Okay. Okay, yes, across the board. Great. Sorry about that. Anyway, Morgan, again, thanks. And thank you, everybody, for giving me the opportunity to steal some of your time during the trading day. I know this is prime real estate as far as I'm concerned, and hopefully it is for you too. That means you're making money in the stock market. Before I get going here, I want you to note that I put up my Twitter and StockTwit feed up there at RacerNick, no K. I do contribute a lot up there. And I don't do anything personal. It's all on the stock market and or news that are relevant to anything that I do trade or track or interest any of my followers and members. So if you have a minute, jot it down. I bet you'll find it useful. Okay, as far as what we're going to do here today, we have big agenda. But one thing I want to keep in mind is that I usually like to keep mine. I did not start out in the trading community like everybody else, working with Morgan Stanley or anybody. I did it on my own. I'm a regular guy. I'm an engineer, electrical engineering, and I climbed the ranks, so you'll see that. So it's going to be no technical jargon, maybe a couple of notes here and there, but I'll explain it just so I can reference to it. But it's going to be casual, and you guys are going to be able to ask questions, so we can go that way. Past lives, I just mentioned it briefly. I started out as an engineer, electrical engineering, and then got into marketing and finance, and then I got lucky in the internet, and then I decided I want to do something. No differential equations. No, that's pretty funny, DW. But if you want to talk about it, we can offline. And anyway, so I did dump everything. And not recently, I mean, in the span of a lifetime, I said, you know what, I'm just going to concentrate on something I enjoy, which was the stock market. And then after the 99 bust, I said, you know what, the stocks are not paying me back. I'm going to go into options where I can define the risk. One thing you'll learn is that I am super conservative, and yet I'm making a living doing options. Those usually don't, no linear algebra, those usually don't go together, but they do in my case. I'm best at, if you give me a set of circumstances, I can plan around them and act accordingly, as opposed to taking a bet and it's a 50-50 shot. When you buy a stock, it's a 50-50 shot. So I'm conservative. That's part of my background, and I'm doing nothing but options. And the best part of my day is when I'm helping members. My members on MarketFi.com. That's like the most satisfying part of my day. The feedback I get on a daily basis. It's pretty busy. A few hundred messages a day, but I answer all of them within a second. Now it's full-time options, basically spreads. More importantly, credit spreads, and we'll talk about why. I do help investors on MarketFi.com. They provided me with a platform, and it's been unbelievable. I think I started February, up 30%, a little more than that. But most importantly, I mean, the team there is so good. It's been nothing but fun. How do I do it? Just base hits. I don't swing for the fences at every shot, but if I get a home run, I'll take it. But my promise is deliver base hits and avoid trouble. I do contribute to StockTwits and Twitter often, and I sometimes tick off the occasional Kramer, although I don't hate anybody up there. I'm not belligerent. I just provide my thoughts with charts usually. So this is a little blurb as to who I am, and as far as why should you listen to me, I can show you that I've been doing it, and most of my strategies, all of my trades in the folio at MarketFi are 95% safe, and you'll know what that means in a little bit. When you buy a stock, it's a 50-50 chance you're going to make money. It either goes up or goes down. So I don't like those odds. I like to tip the odds in my favor. I think there are a disclaimer or two to go through, which is the usual, risking, trading the markets is risky, and definitely in the options trading is definitely riskier if done improperly, although it helps me contain my risk, in my opinion. they gave me a few questions which interest me. I tried to formulate them as best as I can, and I don't know how we're going to collect that information, but Morgan is probably all over it. I wanted you to think about yourself. How would you describe yourself a little bit? Never traded before, active trader, hands-off trader, just following somebody else's strategy, or professional active trader investor with a winning strategy. So you can either just answer in the stream right now, and I can take a, so okay, I see a B, B, okay, a lot of B's. B, 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 A. Never traded before. Welcome, A, Richard. B, B, B. Okay, it looks like everybody, at least the ones that answered, never traded. A couple of A's, mostly B's. I don't see a lot of C's. There's one C. Oh, we're tracking them right here. Perfect. Awesome, awesome. All right. It looks like 3/4 of you are about B, active trader, beginner, intermediate. Perfect. Then I speak your language. Love options. Go with William. Love them too. 4, professional. GS. Goldman Sachs is in here. Okay, so what best describes you as far as your biggest trading problem? Here's another one. Okay, enough with the A's and B's over there. Lose money. I win nice gains. I need better overall strategy to make money. I'm trying to think, if you were a B up there, you probably get a lot of A situations here. C, 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 C. Okay, perfect. I know how that's going to go. A lot of C's. If you've been doing spreads, I bet you have a lot of B's in there. All the B's guys, I bet you they've done spreads before, credit spreads, right? Am I right? Okay, so great. I appreciate your answers there. See you always. Yes, yeah, I hear you, Brian. Okay, today's agenda, I told you it's going to be low key. I'll try to keep my eyes on the thread as much as possible. Try to tailor. New to credit spreads, welcome. Leaps, sure, you can do leaps. I don't like them. I like to see my trades expire within the next 30 days or so, unless special. I did do a leap today. Okay, so today's agenda, I'm going to concentrate on credit spreads. Obviously, that's my bread and butter. That's what I make my 30%, believe it or not. I'm going to show you real examples in that from recent time, and I'm going to show you how safe the trades were. And I'm going to go for as far as margin of error, kind of like room to breathe. Should something go wrong? Should I be not 100% correct in timing and level, etc.? When do I hedge? When do I not? And trade management, which is extremely important. That's where most everybody falters. So, several really example, and it is consistent enough to make income out of it, and that's how I'm doing it for the members. And myself, I take every trade I put up there. I call it, uncertainty. This week showed us how uncertainty can roil markets. Even though you might be 100% convinced of one way or another, then you get uncertainty from political shenanigans. What do? I put a lot of things on hold. Yesterday, I bought a whole bunch of protection I didn't really need, but it would have been ridiculous not to buy it. I closed out a whole bunch of trades. I had credit put spreads on Apple for 450, 445. I closed those yesterday for a penny, but I still had to close them. It was a big position. I just couldn't leave it open in case we whoosh down on a no deal, So, yeah, we'll talk about when to get out and all of that. So you can't take chances, and that's uncertainty. And for me, credit spreads make it bearable. If you tell me how much I'm going to make and what's the maximum loss, I can take that, and then I can plan around it. So that's what makes it bearable uncertainty, in my opinion. So that's what we're going to do today. Quick overview of credit spreads. Hopefully, a lot of you know what spreads are. If not, the next page will probably, we'll go through it and it'll be clearer to you. But those of you, it looks like a lot of you already know what credit spreads are. Let's go through. Number one, I like options versus stocks. I already said that earlier, just because I get more bang for the buck. Really, that's all it is to it. Defined risk with stock, the risk is 100%. You buy a stock, yes, defined risk, perfect. If you buy a stock, it can go down and lose 100% of your money in theory, and it does happen. You know, AIG, GM, a whole bunch of companies went bankrupt if it wasn't for the bailout. And some actually did go bankrupt. Lehman, Bears. So options versus stocks, I know how much I'm going to lose. It's the premium. Then I can make it even tighter. I'll do spreads versus straight options. Then I can, yes, limit my profit, but even define my risk closer. So if I know how much I want to make, I want to risk less to make that goal. Why not? So spreads definitely win over straight out options for me, especially around earnings. You know, lotto tickets, if you want to take a flyer on Goldman Sachs puts or IBM puts, they would have paid, right? But if you had bought the 170 and the stock ran up, yesterday I had a call spread on Goldman Sachs, but it was a spread. I closed it last minute for even money. Had I not closed it and had it been straight out call, I would have lost all my money, right? But if it was a call spread, I would have lost a little bit less because I risked less. So I like risking less for making safer money and losing less in case I'm wrong. And then comes into credit spreads. I'd like to gamble with other people's money, and this is basically what it is. You tell me what's my maximum risk, give me the money now, I'll take your money on the bet, and then wait it out. And if I don't trade willy-nilly, I will lose way more than, I would win, whoopsies, way more than I would lose. My hit ratio is over 92%. Actually, it's higher than that if you just consider just the credit spreads. And that's pretty darn good in credit spreads. I know the question is going to come up, but that one will wipe you all out, blah, 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 blah. We'll address that later. Okay, bucking the myth, that's part of the myth. I get a set of questions all the time. Well, you're risking, $4 to make $1. Yeah, to me, that's pretty good odds. Or $4 or $4.50 to make 50 cents. To me, that makes sense. There's two kinds of risk. Write it down. Hi, Khalid. Two kinds of risks. There is incident risk, which is the chance of something wrong happening, and dollars at risk is how much is on the line. I'd rather put more on the line for a much lower incident risk. So I would rather put, instead of just risking $100 right here with, Apple at 500, I'd rather risk $5,000 with Apple at 420 or 430. That's me. So I'd rather risk more dollars, but much safer bet. Instead of 50-50 when you buy or sell a stock right now, I'd like it to be 90% plus. Why not go 90%? And I'm willing to risk a spread of $5 to collect 50 cents. Just me. So bucking the myth. You need tools, obviously. You looks like you all have tools, and you have all the tools necessary. All you need is experience, which comes next. So if you don't have experience, please, 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 please get help until you gather the experience. Because without experience, you're going to falter often, or at least sometimes, and they can be big. I've helped people that were in jams. I have a couple of people that are already in jams from way long Apple in the 700 area and 600 and 550 calls, or puts sold naked. Never ever sell naked options. Never ever, never ever. Write that down. That's even more important than anything else. Don't sell naked premium. Never. So I heard the presenter before me said you got margin calls. You will get a margin call if you're playing with naked options. I guarantee it. That one point or another, you're going to get a call. You need 100 grand in your account right now, because you think you got a handle on all the variables, but then they change the rules and they hike up margins 2-3 times overnight. Does that experience count? Of course. That's what I call it, tuition cost. Edwin. $5 stock, why would you do options? Just buy the stock. It's so cheap. Education is key. So keep that in mind, Gail. Education. Consistency. I want to be consistent. You cannot be consistent if you're playing close to the line. By the line, I mean current price. You have to go away from current price in order to give yourself a chance at better consistency. So I think I spent enough time on this one, so I'm going to have to speed up through the other stuff. Clock is ticking. Options versus stocks. Why? Okay, I took this recently, I can't remember when, but anyway, FedEx, by the way, wow. Today I was looking at shorting it, and I think I'm going to go about 130, 135, something like that, do a call spread up there short. 120 at the time, it was up 4% in one day. So still underwater in Apple. Valerie, message me. I can probably help you out a little bit to put your shares to work. If you're sitting on some losing positions in Apple, you can put them to work. Okay, so 4% bump in FedEx. Great if you own the stock, right? But you had $120 per share on the line. You're welcome, Val. And so it's very impressive. But how much you had on the line? So it's bang for the buck. Okay, what if I had, instead of bought the stock, had bought an options? You know, this doesn't happen every day, but this just illustrates the point. So if you look down here, I don't know if you can see my pointer. Down here, do I have a pen like Madden does? Tools, maybe under tools. Anyway, maybe in a little bit I'll figure it out. So down here is 1,400 times. So I would take the 1,400 times and have risked much less. So this, you know, if I had owned the 121 strike call, I would have banked way more bang for the buck. So yes, it's impressive to be up 4%, but how about 1,400%? I'll take that any day. The mark change was about $1. Almost 96 cents. So you bought it for pennies, you made almost $1. That's nice. So, but you say, well, you remember I said I like spreads, and then you say, well, spreads would not have worked. Yeah, spreads would have worked. A little bit less, but it's still better bang for the buck than straight up the stock. Maybe it's less dollars, but it's definitely more bang for the buck. Okay, so this is the quick version of options versus stocks. And then this is, by the way, an option chain spreads as opposed to regular strikes where you have puts here, single put legs, and then single calls here. I changed it to having spreads. This way you'll see what I was talking about. Now, instead of just buying the spreads, I prefer selling the spreads. And remember what I said? There's risk of incident versus dollars at risk. Okay, so risk of incident is 5% if you sell this one. Dollars at risk is $5. See how that's a $5 spread? And the risk of incident is probably 5 to 10%. I'm just eyeballing here. So if I sold this one, collected 33 cents, I'd have 85 of success versus buying Apple at 500 and I have a 50-50 shot of making money. I'd rather collect the $300 if I did 10 contracts after fees, and this is just 11 days. So in 11 days, I made $300. That's a decent trade, and depends on your bucket that you're playing with as far as how big your account is. Just do the math, and you can back into a good size income if you have enough money. So if you don't, you can build it up, one shot at a time. If you can't afford $5 wide spreads, there are plenty of stuff you can trade at $1 wides. Wasn't the other one $1 wide? Here's a $1 wide, so you can play FedEx with $1. There are plenty of stocks that play 50 cents too, and indices. Okay, so this is why I like to sell spreads, and those are called credit spreads. They're called when you write a spread because you're basically an insurance guy. What you do is you're selling insurance to somebody who's buying insurance, and then you're hoping they don't get into a wreck. And if you see them driving erratically, you say, you know what, I better build myself some more insurance and do something else. Maybe do the opposite somewhere. Just give yourself wiggle room, and you can see the accident happening. And if you do, you adjust. So it's kind of like sometimes what I do also, I sell a spread to get money to finance something. So if I'm looking to, if I was really bullish Apple, I'll sell the spread, and with the money, I buy a call spread or something higher up here. It's just, different ideas. And somebody said they were buried in Apple. We'll talk about that later. I don't want to do it right now. Okay, key ingredients. I already mentioned them. This is visual. Risk size, risk position, and risk management. So risk, risk, risk. How much money am I putting on the line? Can you just say what is credit spread versus debit spread? Sure. Let's go back. Somebody's asking what's a credit and what's a debit spread. Okay? Debit spread, if I buy this spread, I'm buying it. My account gets debited money. So I'm buying an asset. And if Apple falls in price, that asset grows in value, so I make money. If I'm bullish Apple, I wouldn't do that. If I'm bullish Apple, instead of buying the spread, I sell the spread because then I want Apple to stay away from 470, higher than 470. So when I credit, I get a credit into my account. Hi, Jack? Okay. Risk size, risk position, risk management. So it's all about risk. What do I do with it? How much I'm risking, where I'm risking it, that's the position. So how much is the size? Where, I'll get to that, Patty. Where I'm risking it, that's the position. And what do I do with it until it expires? That's the risk management. And throughout all of this, zero hopium. If you're hanging on to a position that's a credit spread and you're just hanging on hoping it expires worthless or hoping it gets better, oh man, I don't know. You have blow-ups on your hand. Okay, Patty's asking, so you said not to ever trade naked options. No, you can trade naked options. Don't sell naked options. Covered options, yes, you can sell covered calls as if your particular position is conducive to doing so. Account size, it's a personal question. The bigger the better. You know, you can start with 5,000. If you had 50,000, it's much better because then you have so much room to do stuff. Hopefully, I answered that, Patty. Okay. Yes, good for you, Valerie. Okay, so this was risk, risk, risk. Okay, how much? Where? How do I deal with it while it's on? And don't hope. Have a plan. Whoops. Okay, so the ingredients are timing. When do I get in? You better have a macro plan. Does everybody know what a macro plan is? Do you have a macro plan? Give me a quick answer. What's a macro plan? It's what do I think in the world? Like this year, what's going on? I cannot invest without a macro plan. If I don't know where the market is going or the world is going, how can I invest? So my macro plan is 2013. Nothing has changed, by the way. Bubbles pop. There's not going to be popping bubbles anytime soon, and if they do, the world feds are behind us. So the safety net is out there. So I don't see a doom scenario, and I don't see a top. We're topish, and we'll get to that later, but it's not a top. There's room to go. And believe me, I'm not a staunch bull. I got hurt several times trying to short this crazy market. Macro plan is, it's not the top, but there's no, bubbles are fun, and it's no doom scenario because all the feds are, the world feds are behind us, and they're willing to do whatever it takes, whether fake or what. Who cares if it's fake or not? Okay, so establishing that, the macro plan, then I go into a micro plan. Okay, what's Apple doing? What's Google going to do tonight? What's Chipotle going to do tonight? So you see my thought here. I develop a macro plan, and then I develop a micro plan, and I act accordingly. Level picking, okay, where do I place the bet? I look at the macro, and then more importantly, I look at the micro, and then I determine how much buffer or room I need, and then I place the bet. I definitely know what I'm buying. It runs out of gas. If I'm getting a trade into Google or Apple, I better know everything there is to be known about that stock. So how do I do that? Watch list, people, write it down. You need a watch list. And by that, I mean not just put it on and see the price. You need to track every bit of news. Junk news, forget the spam filter. I get hundreds of emails a day, and my Google email is perfect for filtering all the junk. I mean, it's so easy to use. So do yourself a favor, don't be scared of spam, because I need all the junk, because among all the junk, there's one golden goose somewhere. So I look at all the emails, go through them real quickly, and then I get educated about all there is to be known about the stocks and indices I'm trading. So I get bombarded by Benzinga, in good ways, by Yahoo News, this news, that news, CNBC, blah, 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 all of them. I deal with all the junk in order to get to the pearls. And so that's what I mean, know what you buy. You need a watch list. You revisit the watch list 2-3 times a day if you're an active trader. Hedging, it is needed, but not every time. Sometimes it does more harm than good. You can even hedge after the fact. Printing money. I don't believe in printing money. I'm just saying what the environment is. I'm not giving an opinion. I can't control it. I can't influence it. I see what's going on, and hopefully I can trade within the range. I don't condone printing money, but if that's what it takes to, yeah, exactly, Rich. If that's what it takes to get us out of trouble, so be it. I don't understand this hatred towards opinions. It takes two opinions to make a world. You can't all be bulls and you can't all be bears. I do disagree with going to extremes to get things right. The end does not justify the means, and that goes for the Tea Partiers out there too. I don't vote either way. I gave up on that a long time ago. Anyway, so managing trades is probably the key where the place where everybody makes mistakes. You can close out early. I call it a scalp. Yes, you can scalp with credit spreads. I do it all the time. As a matter of fact, you can scalp with other people's money. You can close at a target. When I enter a trade, if I collect 30 cents, I say, you know what? As soon as I hit 10 cents to buy it back, I'll close it. I'll pocket the difference. I made 20 cents in 3 days, 4 days. I'll take it. Or I can hope for the best, which is part of hopium, and let it expire. I almost never let them expire. I always buy them back. I say never keep risk open for 4 pennies or 5 pennies. If it costs 5 cents to close it, close it. And when to cry uncle, when to give up, throw your hands. You know what? I was wrong. This trade is dead. It's dead to me. So this is an important point. You don't want to do it too often, too soon, but you better know your environment before you actually do it. So I'm going to start speeding up here because I feel myself falling behind. And I'll go back and examine them closely if I need to. So what does this all mean? Let me just jump into examples and let's go from there. I'll start with a September trade. This part right here is a snapshot right out of the MarketFi service that I run up there. This is a September. RUT is the small caps. It's the ticker. It's expensive. It's in the thousands, 1,100 almost, 1098 today. I love trading it. It runs fast, so it carries high premium. Sometimes it's hard to get the premium you want, but there's enough room to get it, put it to work. So this is a trade that paid in 10 days, maybe 11 days. What happened here? I entered the trade. I collected 30 cents. It's a credit spread. This is a bullish RUT trade. It's a credit put spread. And I paid, I collected 30 cents to open the trade. I closed it for 3 pennies. Remember I told you close cheap risk? So I took on the risk for 30 cents. And then when it got down to about 3 or 4 pennies, you know what? I'm going to close it. And how safe was it? It was 95% safe. What does that mean? When I opened the trade theoretically had 95% chance of success based on how far away from price. So that's probably about 6% buffer. So the market needed to fall 6% for me to start losing money. So it was well timed, and I think we entered it here and we closed it there. Trying to line it up. Yep. Anyway, so usually, let's say market is here and I want to open a trade in RUT. I usually open it down here. So I give myself a big buffer. And then if I'm looking at this, sorry about all the lines, but you can see the yellow line shows a nice, decent trade. I think these are called inverted scallops or something like that. These shapes, you see that shape like half an umbrella, the right-hand side of an umbrella. If it gets down to halfway of this side, it tends to repeat. See, about halfway to this side. Here it repeated only smaller. And then we got the stupid Washington scare, and even then it didn't break it down. So now it might be on its way to doing it again. So I wouldn't be surprised if in another couple of weeks it wouldn't be out here still. So that's my point on RET. So we did that, right? So now what do we do next? Well, guess what? Let's look at it first. So I opened it for 30 cents. I could have let it expire for max gain. Max gain is the whole 30 cents that expires worthless. But and then I bought it back for 3 pennies. It may not have been the perfect thing to do because hindsight, I didn't need to pay that 3 pennies to buy it back, but it's the right thing to do. So it's not perfect, but it's right, and I'll do it over again. 3 pennies, I'll pay it. Guess what? I rinsed and repeat for October. So September, made $400 in 10 days, and then reopened it for another 200 and some dollars, a little higher. So my risk was at 1,005. So the market would have needed to come down to here for me to start losing money. I took the chance, and then again, I opened it for 32 cents. I wait until it got down because I saw some trouble coming. So I said, you know what, 10 to 14, 2 weeks, we're out. It took too long for me to get more money out of it. I closed it and moved on. So then we have, guess what? I did the opposite, which is I entered 924, same day. I did the opposite. I bet against the RUT, which is a credit call spread. So I was bearish. That's a bearish trade at 1145. So it would have had to go up to here to break me. And that premium was only available for like minutes. You know, boom, I sent out the trade alert, and then next day or 2 days later or something like that, I could have closed it immediately for like, and then closed it for another 3 cents. So these two are called an iron condor. You've heard that. So I prefer weekly options. I do prefer weekly, but chillax. I don't like, hey, we're having a meeting over here. Enough about the Fed. The weekly options are good to play, but I recommend you don't play the weekly options throughout the week. In other words, all right, Valerie, thanks. Don't risk the last few minutes. Why? If something goes wrong, you're wrong all the way. You have no options. Speaking of options, you have no way of getting yourself out of trouble. That's especially with this guy. This is an AM settled issue, so you cannot trade it on Friday, and it settles based on Friday open, not closed. Yes, SPX is the same. For the weekly, it's PM settled, but for the monthly, it's AM settled. There is an SPX PM that settles at night on the close of Friday, and you can trade it on Friday. However, it's only available monthly. So to answer your question, yes, I do like weeklies, but I tend not to play them. Like I will play next week's now, and I'll probably close it Monday or Tuesday for the. If it didn't make money, that means it's not going to, or it's too risky. I'll just close it and try it again for the week following. So weeklies are great, especially for defense. If I have a November position that's bullish and I see the market iffy with the Washington thing, what I'll do is I'll buy very cheap, like pennies, similar opposite trade for the weeklies. So next week's will be like 5 cents to buy, and that covers me in the oh crap scenario that may or may not come. But I paid $40 to protect my $5,000 position. I'll take that insurance every day. I'll sleep better. So yes, weeklies are great, and you can use them both in conjunction. I was looking to do that today actually with IBM. Do a credit spread and then buy a weekly put. So to cover myself and the mark. So this is what it looks like as far as my trades on MarketFi, and these are in sequence, and it's 2 pages because it wouldn't fit. This was a protection. It was a debit spread. It wasn't a credit spread. But you can see the RUT trade 234, Apple trade 255, and I'm only doing 10 contracts, 15 contracts. Normally I do way more than that, but I don't want to intimidate any of the members, so I go with 10, 10, 10. Sometimes I step it up to 15, just so that I don't shy everybody out or force them into bigger trades. Do I change strategy or anything? Absolutely. I'll get to that in a second, Valerie. Remind me of that, please, if I forget. So this is 1 page going down. These are in sequence, by the way. CF, win, 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 win. This wasn't a loss. This was part of an iron condor. It was 3 trades. It was this one. So I'm already positive right there. And there was another one that's probably lower. This one, it was like $200 somewhere else. Anyway, so it was three-part trade. And again, this loss here was a long debit spread. It was a protection that I didn't need. So, and Netflix was a tough trade for me. And even that trade, we ended up managing out of it with minimal damage. So green, 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 green all over the place. So at this time, I wanted to see if I could lay it on you. Okay, I said I'm going to give you examples. I'm going to look back as far as what happened and can I repeat it. Okay, back in June, I did a couple presentations. I can't remember if it was Morgan or not. June and July, May, June, and July, I did 3 presentations. And I said, here are 3 trades I would take right now. And whoever was on there, if they had taken those trades, they would have made money. So what was it? Okay, I had a thesis. Remember I told you I had a macro? My thesis haven't changed. You know, we're toppy, no doom scenario, we have room to run. Thank you, Roger. And I'm very conservative, I told you, and I keep on top of it every day, all day. Like right now, I have another computer next to me with the market open in front of me so I can make sure I keep tab on it. I'm not liking what's going on with Google right now. So the general strategy is to go long proven performers on pullbacks, mostly with credit put spreads. CPS is credit put spreads. And then I hedge with higher weeklies. And then I go short on the extended ones, although I'm not going short anymore too much unless I absolutely have to. I just closed a big short in MasterCard that made me change my underwear quite a few times. But it is you know, something that I couldn't resist. I'm tempted today, although earnings come into play, and I don't play earnings unless it's a lotto ticket, and I'll explain the differences. Hedges when possible, definitely. So this was the thesis. So I did 4 trades in June. In that June presentation, somewhere in the middle of June. I said, okay, there was an NDX is a NASDAQ. I did a credit put spread, 28.40, 28.35, paid 80 cents, and it was 85% chance of success, theoretically speaking, and it was about 4.2% lower than price. So the market would have needed to drop 4% for me to lose money, start losing money. And I collected 80 cents for this bet. And it just had a couple weeks. I mean, not a couple weeks, I'm sorry, but maybe 35 days or something like that. So I said that's one bet I would take. Another trade, if somebody has a bigger bank account and they can take $25 spreads, safer. So this one paid $2.50 and risk reward. Okay, I'll get to that pick in a second. The spread is, when I say paid, I don't pay, I collect. It's paid. It's paid me. I didn't pay it. I'm sorry, I misworded it, JT. I collected 80 cents for the bet. And if I was right, that 80 cents, it is, no, it's not written up there. It said paid 80 cents. The trade paid. Yes, paid off. Thank you, Iman. English is my 3rd language, so help me out here. To judge the percent of risk, the trading platforms have it built in. Yes, JT, it paid me. Sorry about that, so keep that in mind. All of my trades are credit spreads in here, okay? So the collections, these are all credits into my account. So the 80 cents went into my account, and by 8/16, it would have been mine if I'm right. And then the other version of it, same time frame, only bigger spread. This is $5 wide, so I sold the 28.40 and I bought the 28.35, so I collected 80 cents. Here I sold the 28.00, bought the 27.75, so there's a $25 spread. Thank you, Vince. And I collected $2.50 almost for it, $2.50, but bigger risk, much bigger risk. You know, I don't like to do these often, but when it's this clear, I jump for it. I have several. Trade Monster it's pretty good for most people, and the more powerful one is Thinkorswim, but it can be a little daunting for people that don't need all the stuff it offers. How many average trading days? Usually I keep my trades open about 20 days, sometimes less, sometimes more, but I don't like to go out too far. So this one was 90%, so it's a little bit safer as far as incident, but more dollars at risk. Remember we talked about that? So for this one, the market would have needed to tumble 5.7%, and then for me to lose money. And then I also said, you know what, I can do the opposite. I can do a credit call spread, hedging my bet, taking the opposite bet. This way, if the market moves this way or that way, one gains, one loses. Overall, I still can close it for even money should something happen, like And this one paid 85 cents, another 85 cents. So if I did this one, I would have done that one. I collected the $1.60. And all I needed is the NASDAQ to be between 28.40 and 31.50. And they both ended up winners because it did both of those things. Also, I did the same type of a trade with the SPX, which is the S&P. And this one paid 85 cents. It was almost 90% safe, and the market needed to drop 5%. You can vary, you can play around with the levels and the width of the trades, but you get the point, right? So I did those trades. Whoever was on board, if they had taken those bets, they would have made at least a mortgage payment or two. So it is doable. Credit spreads do pay. You don't have to go 80 cents at every spread. Cut that in half and increase your chances of success every time. I will do it every time. The visuals on those from that time, this was the NDX, just to give you an idea. I'm not sure it's going to mean much to you here, so I'm going to skip through. And this was the SPY. Even after a debacle like this, I usually get courage and then trade somewhere down here. So I don't know if you guys use technicals. I use them all the time. All these lines mean something. I know it looks like Edward Scissorhand is helping me do these lines. Happy birthday, Stephen. It looks like it's crazy, but look, these two yellow lines give me a nice up channel, right? And as soon as this happens here, it's like, whoa, major development over here that broke the channel. So now it's going to be probably start. So I'll keep an eye on that. And then this blue line here is a regression line. If you don't do this kind of stuff, then you're just trading willy-nilly. Commissions will kill you. Yeah, you don't have to trade there. You can have an account there for research and trade somewhere else. So get to know your charts. Get to know your charts and get to know your technicals. I'm not a technical guru, but I've developed some good technical skills, and you can see it on Twitter, even intraday. If somebody, I don't trade intraday, I don't try to scalp intraday, but I use the intraday moves in order to determine when to enter a trade. So if I'm trying to time a trade, 1.5 a contract, is that too high? I don't know. Go to Trade Monster. I don't get any money from any of these guys. Go to Trade Monster, and they have a comparison page that just shows you all the big guys. So that's pretty helpful. So this is another trade I did was the RUT. I just mentioned that. That's the small caps. July credit put spread along with those 4 trades I told you. This was another trade. I just didn't mention it over there. Paid about 25 cents, and it was totally safe. It never even got close to getting hurt. As a matter of fact, I just re-entered that trade for November, and it's almost, what is it now? Let me see if I can find it real quick here on my screen. It's 7 cents, 8 cents to close. So I can close it now down from 43 cents. I sold it for 43 cents. Now it's 8 cents. So made cool 700 bucks on that position in just days. Okay, so why doesn't everybody do that? Because things are not perfect all the time. I mentioned the RUT October spread, that 1,005 spread got under pressure. It survived eventually, but it got under pressure. So if you look at your P&L, you'll, oh my gosh, I'm losing money. But it's paper losses, but it's something you need to pay attention to. So it was down like 60 to 100%. What does that mean? It means I collected 30 cents, right, to open it. So now I got 30 cents times, let's say 10. But now it shows that my trades are never in the money, as far as in the money the wrong way. Hopefully you're talking about different things. So this 60, now it was 60 cents to buy it back, to close it. So if I collected 300, I have to pay 600, so I lost $300 to close it. So what do? I could have booked some profits along the way before it got to that point. Then I would have had one winning trade and some money in the bank and eliminate the Washington shenanigan. Or if I left it open, I'm stuck in a pickle. What do? So I think what happened there, I did all 4. I have slower traders with the members. I said, you guys need to get out of the 1005, even though it was still about 3.5% away from trouble. So the market needed to fall another 3% for it to be in trouble. But if you wait for that to happen, then you got a big problem on your hand. I didn't wait. I acted right then and there. Well, those guys, I sent them to November 955. So they collected more money to close a risky trade into way safer area and a lot slower mover for more money. I mean, why wouldn't you do that every time? Instead, you dig in your heels trying to close it in October. What's the point? Just send it out to November, collect more money, you have a better chance of surviving. That's one way of handling it. I stood my ground because I had a little bit of protection, and then I had also belief that the floor was there. So I stood my ground based on my thesis, and my thesis was not broken, so it was going to turn around. Plus, I'm a quicker trader. I'm nimble. I held. I can, pull the trigger. But you could have also booked some profits along the way, which everyone should do every once in a while. We all tend to want to get the whole basket if we can. Well, guess what? It doesn't always happen the way we want it to. So don't be greedy. Take profits whenever you can. If not all, just partial. Here's another trade I told you. I had shorted MasterCard. That's one short. That's not the one that made me lose a few pairs of underwear. But this was what I did in the, and this is what I did in the actual portfolio for the members. They collected $150 in just 2 weeks or so, 3 weeks, 2.5 weeks or so. And it was a short to MasterCard at 725. Relatively safe bet. We collected 30 cents. We closed it early. Remember I told you, sometimes you got to close it early. And sure enough, jumping, boom, boom. So scalping is good. This is a 15-cent scalp. It's not an overnight scalp or anything, but scalp nonetheless. This is another trade that was the SPX, okay, and I think I entered it right around here, and guess what? It got into trouble a little bit, but with Washington, but we held ground and we closed it. We were able to close it for 5 cents because of where we set it. Look at this, 1580. The market was almost 1700 or 1680. I opened the bet right here. I said, I bet the market is not going to get here. And I collected 25 cents for that. Right here. That's what Washington did. High premiums. Can you just go through the 1, 2, 3, how to find these trades? I think, Matt, I just looking at, if you can see the screen right now, okay, the market was right here. And I said, you know what? I bet you anything the market is not going to get down to here in the next couple of days unless we get a huge disaster in Washington. So I said, Matt, I said, okay, so I can take a credit put spread, and I set it. Now, I didn't just willy-nilly here. I track the SPX incessantly. I'm looking at it every day, so I know it's time. So I jump in. I know today, tomorrow will be time to do Google. I'll jump in. Which brings up the earnings part. I'll do that right now. Earnings. They're gambling. Tell me I'm crazy if you think so. Earnings, playing a full position in earnings, you're 100% gambling. 100%. You cannot make, exactly, Fernando, flip a coin. It's a coin toss. Go to Vegas. Go to Vegas, and you'll make we'll have more fun. Book Iron Condor. Well, you know what, Matt? That's a great in theory. And what if it doesn't? What if it jumps beyond that? And then you're instantly in the money wrong. Okay? Let's say you give yourself a $50 spread on the Google earnings tomorrow. Remember what happened to Google when the debacle, released earnings early and it dropped $100 in the middle of the day? Yeah, that could happen. You're just flipping a coin and hoping for the best, Matt. My advice, my take on it, earnings should only be played lotto. Yes, I do. Lotto, Valerie. Lotto style. What does that mean? I pay a premium, usually cheap, for a long shot. So Google, 900 now, 890, whatever it is, 889. 889. I say, okay, what are the chances of it being 920 tomorrow? or 9:30 or 9:40. They're probably not. Or next week, what are the chances of it being 810? I don't know. Pretty slim, right? Or 850. I'll open a debit put spread around 850 just in case people want to spit all over Google. Or I'll do the opposite and I'll say, you know what? I think Google is going to be, wow. They're going to say, hey, by the way, does anybody know what the hell happened to them splitting the stock? They were supposed to do that like in 2010. What the heck happened? Nothing. They announced it, but I think they're in the litigation. So what if tomorrow they say, you know what, tonight the litigation is over, we're splitting the company, and suddenly the stock is up 200 points? So I think it was Matt said, what about an iron condor? Yes, in theory, yes. But yeah, that split, Valerie, was different. So they were going to split it into two different companies, not splitting the stock into. So the earnings plays are complete gambling positions. Therefore, I think they should only be lotto. So pay a premium for a guess. Guess which way it's going to move. Guess how far out. Pay a little premium. For example, yesterday I ran out of time. I wanted to gamble on IBM. I said, you know what? I have a feeling it's going to get down to 170. I was going to buy the 170 put. It was like 7 cents or something. I was going to buy like 15 of them, 15 contracts of 1,500. I wish I had. So the idea of playing in earnings with credit spreads is crazy to me, and I've been doing this for a while. So more scalps. I've shown you a whole bunch of examples here. I only have 18 minutes left. That was the 450 I was talking about. I closed some along the way. We opened it for 31 cents, then Apple started going down and started looking a little scary. I wish I have an Apple chart up there. I'll show you why. And I said, you know what? Let's book some profits. 17 cents in 5 days. I'll take it. $250. That's following me, and they're profiting along. Let's do it. Here's another trade in September we did. RUT again. 930, 925. This one didn't even break a sweat. I mean, 10 days, bam, 27 cents. So it was a nice profit. Hedging. I talked about hedging. Doesn't make sense, Iman? It's not on autopilot. The only reason I call it is scalp. Iman is saying scalp over several trading days doesn't make sense. I borrow the term scalp for credit spreads. It's hard to scalp in credit spreads unless you get real lucky timing. But in my case, the idea of scalping in credit spreads takes a little different tone. If I open a credit spread, I intend to hold it for a couple of weeks. If I get to close it within 3 days at about 80% of what I could collect, I call that a scalp. So closing it early. Vic saying, can you show, these were all my trades. Those are all my trades in a row, Vic. You can go to marketfy.com, browse products, find my product, which is create income with credit spreads, and look at the closing trades. I never lose. I wish. I do lose, but small, and you saw them, little red ones. 92%, it's probably a little higher if you just consider the credit spreads. That's because I told you I'm conservative. And if I smell a rat, I close it. I don't wait for it to go sour. I don't hope for the best. Marketfy.com, marketfy.com. Can you guys, here, let me. Morgan, can you help me out and throw a link to my product if you have it somewhere handy? They offer a whole bunch of services. Thank you. A whole bunch of services, and I have a product up there. If it's a trade alert service, I have several products, but the trade alert service. Yes, Mort, I have to roll with the punches, and if I see unnecessary risk, I back off some of the trading. My priority is to save, help people make money and not risk their livelihood. So anyway, somebody asked something else. Played an iron condor on IBM. Matt, good for you. But like I said, it could have gone the other way. So actually, that's an iron condor, 180, 175. So that's in the money right now. Your credit put spread. How are you making money on that? Hmm. Okay. Maybe the overall trade. But still, you don't want to be exercised on if it's in the money with 2 days left. By the way, if you get exercised on, and anyway, there's a whole bunch of issues. I heard somebody mention earlier exercising. There's also dividends. You can end up owing dividends in an exercise situation. Hedging. Do you consider hedging every time? Do I put it on every time? No. I don't ever assume I don't need a hedge, but there are some things I don't like to hedge. Don't hedge every credit spread trade because you might end up regretting it, like that Netflix trade I had. If I didn't hedge it, I would have been in the money the good way. I would have cashed, and I'd have to worry about the other one. But hey, hindsight is 20/20, right? As far as hedging, a big issue is people sometimes forget you got to hedge the overall portfolio. If you look at your overall portfolio and you're too long, then you should hedge something or bet against that long. Otherwise, if something goes wrong, then you lose everything. So hedge depending on the overall portfolio. So bullish, bearish, you got to hedge if you think you're one way or another. And you can do it via stock options and credit spreads, of course. So now what? I blah, blah, blah for a whole hour or so. Now what? What am I, bullish, bearish? I don't care. I'm playing the range. So I don't care if the market is bullish, is bearish. I developed a thesis. I'm sticking with the thesis, and I'm sticking with my trading rules. And I'm trying to play within the lines, color between the lines, as they say. So now I can do that, and I can create a consistent income with trades that, like you just saw, they pay 30 cents, 25 cents, 15 cents, 20 cents, 30 cents, 40 cents, 50 cents. And they're about 90 to 95% theoretically safe. And I know my risk. I know exactly what I'm making if I'm right. And if I see it coming my way, I can adjust it. So we covered risk management as most important ingredient, because after you place the trade, yeah, the site can be a little annoying, but they're trying to help people that don't know a lot about investing. So if be patient with it, Iman. It just once you're in, it won't be annoying as much. Matt, sorry to tell you that, but anyway, trend spotting. I use it all the time. I showed you I think, let's see, let me speed up through this. All these lines, that's how I spot trends. And I use, on Twitter, you can see me use this crayon, and I quote my crayon all the time. When I use my crayon, everything seems so simple. Like yesterday, this was, I think, a tweet from yesterday. I was like, the crayon told me, if I'm looking at it, if I do a line right here, top, 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 and I have the SPX before about here, 1740. So here it is, 1727, right? I have no reason to short it yet. I'll give it a little more room before I short it. So if somebody tried to short it here, now they'd be starting to sweat. So if I wanted to short it, maybe I'll go up here and find something. If I don't, I skip it. And if I do a credit put spread, this is not the best time to do it, but if I do it, it'll be like down here in the 1620s. Somebody had a risk return equal to 50-50. Peter, I don't know, I don't understand. I'm risking less if I go with debit spread, sure. But like I said, I don't mind risking money if I know I have only 5% chance of losing. So determine the parameters that work for you and trade along with them. I'm not forcing everybody to trade this way, but this is what's been working for me. I know how much I'm risking, and I know I'm only risking a 5% chance of risking that risk. Does that make sense? So the dollars at risk are not as a priority for me, as long as it's a manageable dollar that I'm willing to walk away from, as the incident of risk. My goal is to not have losing trades. And that should be everybody's goal. That's the only way I can make it work out as easy as it is. So back to this one, managing trades. So I think, okay, somebody spoke about bubble. Anybody recognize this bubble here? That's a 20-year chart of the NASDAQ. That's the dot-com bubble that burst. But look how we climbed up to it. Look how we climb up to it now. Yeah. So we're about here, I think, right now, maybe a little higher. No, actually, we're still about third place. So if I were to want to short it, I would probably start around the 3,400, not any shorter than that. That correct 2,000. I was there. Yeah, me too, Valerie. But I made it all back with oil, luckily. And that's when I decided to go with options. No name on the current bubble. No, I don't think it's going to be a bubble. It's more of a hump. Okay, the RUT chart, we already talked about it, how it's repeating patterns. You see them, those inverted scallops, whatever they call them. Half umbrellas, let's call them half umbrellas. Summary, okay, now we're off the script, forget that. I told you stocks, I don't like them. Options, I like them. Option spreads, I like them even more. Love credit spreads. Ingredients, really are important to be successful. You can't skip on the ingredients. The recipe will not taste as well. Real examples I showed you, and they're in a row. I wasn't mojoing. These are not cut and paste. I had to cut it in two because it wouldn't fit on one page. Hedging, necessary most times, not all times, but consider the big picture too, not hedging in one place. Like if I'm short Netflix and Netflix is running against me, I'll go along the NASDAQ because if Netflix is running, chances are the NASDAQ is running. So if I don't want to, you can substitute one for another. Trade management, be honest with yourself, very honest with yourself before you declare yourself, okay, I'm going to stand my ground. Why? If you're wrong, close it and move on. Frequently asked questions, I already addressed most of these because of your comments in there, so we'll skip them. Option spreads, Khalid, I would probably, if I was starting, I would probably do Trade Monster. It's cheap and relatively intuitive and not too complicated to figure it out, and if you call them, they pick up the phone. Normally closed thesis, have a plan. The bottom line is have a plan and know when to say enough. The trade has gone wrong, and now I'm going to redefine the trade from being a trade where I'm trying to make money to where I'm trying to contain my damage. If you just sounds stupid. Yeah, Options House is pretty cheap too, but not as good as Trade Monster, I don't think. Maybe it is. It works well. Maybe it's stupid, but a simple thing like redefining your trade. If you have a trade and it's going against you, redefine it. So say, okay, it's a hostile trade, I'm trying to close out of it. Okay, now advertisement time. I know they set me up for this, and all these questions that you guys and ladies had, yeah, I do adjustments, a lot of them, JT. When I see that coming, remember I mentioned it with the RUT, sent it from October 1005 to November 955 for more money. So that was a good move. Okay, now learn what you guys had questions. If credit spreads sound interesting, you're going to need to take the next step, at least with me. I showed you I can do it. I can show you how you can do it. I can even do it for you eventually if you end up wanting to do that. But join me for this next session that they set me up, and it has everything that you guys, all the questions that ran through and I could catch, I'm sure there were more, they are going to be covered. Risk management, really important. How to time the credit spreads, when to get in, to get out. When to not do anything with certain stocks or indices. Where do I put the risk? Remember I told you put the risk where, how much, at what level. Hedging and managing, really important. So consistent repetition will make you money, and that's what I do. And I can guarantee you, if you jump in with us next time, you'll have such a better handle, and all these questions will be answered. Let me see here. Where is it? Oh, there it is. Wow, holy smokes. Okay. Time to sweeten the pot. I will set up 3 trades. How's that? That will make money. that I will take for myself. And I will definitely, it's like put skin in the game. So not only we will go through how I do it, and we'll actually do it. So that I bought next mastering cost better than class. Thanks, Josh. Hey, I didn't even know I had Pete's in here. Sweet. Thanks, Josh. Look at that. Hopefully everybody can read Josh. So I've done it. I can show you how I do it, so you can learn it on your own. And if you feel like you need hand-holding for a little bit, we have that also. I'm self-taught, so I speak your language. I'm not a typical Morgan Stanley descendant of any sorts. I didn't work as a professional trader for any outfit. I learned it on my own. I said, I love this stuff. Keep it clean. And I want to do more of it, and eventually said, you know what, I want to do nothing else but that. And the best part of my day is dealing with my interaction with my members. So questions all day, but they all get answered, actually all night too, because I have people in the Pacific, in a little island behind Japan somewhere, and you know, they educated me on what's going on in that island. So it's really cool stuff. So I answer night and day whenever I'm up, whenever I have internet access, phone, tablet, computer, I answer. I have a few people that prepaid a whole year just so I can be available to them as far as if they had questions, kind of like a mentor or buddy system or something. How much did you start out with capital? At MarketFi, the account had 100 in it. I nowhere near got close to using half of it, so it was there. I just didn't need to use it. Ideally, put 5 trades at a time in the portfolio. Like I said, I don't want to push anyone into anything bad. Personally, I can handle more than that, but I don't put every trade I take into the portfolio. Only the appropriate trades go into the portfolio. Appropriate meaning the risk level, chances of success, dollars at risk, ease of management. Some things are not liquid. ISRG, for example, I love trading it personally, but I try to not do a lot of it in the portfolio. Anything that has a headline in it, I try to steer clear, because you can wake up and the headline could hit, like CMG, you know, and you'd be boom. By the way, CMG, oh man, let me see. Can I switch here? Let me see. Hold on for a second. Can you guys see this? Okay, let me see here. Profit. CMG. Yes, okay. Okay, let me show you perspective, okay? Change your perspective. Don't always look at the same picture. That's 2 years of Chipotle, okay? Look at this. Look at this. If you were a betting person, which way would you bet? I think this is a 50-50 coin flip. Yes, Julie, 50-50 coin flip. Guess what? I'm flipping down. And you know why? Because if they have a bad quarter for some reason, they're going to blame it on the government. Exactly, Valerie. They're going to blame it on the government and throw, oh, it was the government, it was this, it was that. So this is their chance to throw anything negative that they've been carrying on the books and say, this is time, book it now, book it, book it. So it could prove me wrong. And no credit put spread, debit, Iman. Credit, you're putting yourself at risk. Okay, so I don't know about you. That's 2 years worth of look-sees. And then this is the more important. Let me go back to 1 year, and I'll tell you what's my other thing. Pop earnings, pop earnings, pop earnings. Yes, 3 wins in a row. Great. But look at that. Restaurants are seasonal. What happened last season? Drop. So I don't know. If I was coin flipping, as a matter of fact, my cousin just pinged me earlier today. What are you doing with Chipotle? I said nothing. I wasn't going to do anything. So now I have to go and buy puts or something. So I think I'm going to buy put spread. Small, couple $100. It's like, you know, going to Vegas, my lotto ticket. I think it's the second. I don't know if they're old enough to have more than the 2 touches. That question comes from a technical analyst. I guarantee you that. They call them touches, second touches. Are you looking for 3 touches? I call them knocks. Knock, knock. If the door opens or it's a roof, you know. So anyway, back to here. join me. Any questions, call. The team is on board. They're awesome, and they'll help you out. I know $34 these days sounds like a lot of money or wasted money. The value is there, and if you take the trade, you're going to make more than $34 back. That was Chipotle, yes. So Julie says always buy the fourth touch. Maybe. Depends on volume, too. How much do you need to trade my class? The pricing today for Morgan's attendees is $34. And I just got a beep in my ear. I think I ran out of time. The music is playing, people. If you haven't followed me on Twitter or StockTwits, do it now. It's Racer Nick. I'll type it in again. Racer Nick, no K. And if you put the @ symbol in front of it, that's me. Thank you, Morgan. I appreciate it. Should I just leave it in your capable hands right now? Am I out of time? I'm out. Real deal. Thanks, Al. 5 is a good start. The bigger, the better. If you have 10, that'd be awesome. I just started a family member at 10, and he's up 15% already. A couple of months. You're welcome, Steve. Thanks, Valerie. Thanks, Matt. Alistair, you fight MMA? You're welcome, Simon, Fernando, everybody. Thanks, Morgan. I appreciate your help. Again, fantastic event. You guys rock. You can invite me back anytime.
Awesome. Awesome job. Thanks, Nick. We appreciate you being here. And again,